Welcome to Striking Option, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Bob Icino. Welcome, Bob.
Good to see you, Jeff.
Well, great to see you as always, and it's interesting. The coronavirus remains front and center in our news cycle. Earnings season kind of at the tail end, but what has your attention this week, Bob?
Well, kind of the juxtaposition of what you just said. Coronavirus has obviously been the main headline, despite a little bit better earnings performance.
And we did see this morning, kind of a shock to the market, unorthodox, that Apple came out and revised their future guidance due to the coronavirus and the potential effects.
Right, and that's all we're able to discuss, really, is the economic effects of coronavirus, because we're not medical personnel. So that's what we're looking for. Some conferences canceled. There's an actual economic effect to this thing.
And I don't think that's very much a parallel line. Look at the Fed Chairman Powell last week. He's looking for a material change potentially due to the coronavirus. So this is all real-time data that the market is pricing in. Great stuff, Bob. But let's get this first lightning round. You ready?
Let's do it.
Got yield. Well, really interesting last week, Bob. We saw a lot of inflows into the fixed income market. Nearly $24 billion flowed into the market. That is that continued attraction of these assets in the U.S. Treasuries, as well as any search for yield globally. Talk to me a little bit about the 10-year note, because here we are at the bottom end of the range.
Right, and the major economy least affected currently by the coronavirus is the U.S. So one of the places that you can express an opinion, if you believe the 10-year is going to exist in the same range, is by selling the Feb Week 4 132.16 call and buying the 133.16 call. That'll expire around February 28th.
Well, this makes a lot of sense to embrace this range. And the approach here is to really understand what is going on in the global market. As we see historic highs in the S&P 500, they're also seeing a bid into the Treasury market. And when you know a bid in the Treasury market, prices go higher, yields go lower. So it's great to understand and embrace this potential range as we are at the lower end of the range in the 150s, Bob.
Right, 10-year cash yields have been between 150 and 180 for quite a while. The March futures is the underlying contract here. It was trading about 131.035 when we looked at it, and there's a gap actually quite a bit higher than that. Again, that same range we've been talking about.
And it seems like the market's anticipating it is a bit lower volatility. The at-the-money volatility for this approach is 431. So this call spread allows an investor to collect about $36. Not a lot of premium, but at the same time, this is an approach that can allow just a soft embracement, if you will, of this range.
Right, at-the-money volatility is still typically low, but again, while you're in this range, it's unlikely to pop. It could, but it's unlikely.
Great stuff, Bob. And please remember, these are trade examples, not trade recommendations. Let's move to the second lightning round, bud.
Let's do it.
Tech in trouble. Well, we talked about at the top of the show. Apple re-guiding their forward guidance. When you see that revision of that forward guidance, that's substantial due to the fact that it's outside of the typical earnings season statement.
Yeah, once again, one of the main sectors affected by the coronavirus is tech. When you see things like the Mobile World Conference being canceled, you see things like Apple guiding down now because they won't be able to get product. So the tech sector is where you want to look at this.
And right now, Apple down about 3% on this news, but it's interesting. The approach I'm looking at is to see some type of defined risk, some type of risk mitigation by buying a NASDAQ 100 put spread. As you know, Bob, buying a put spread, you're going to pay something for that, but at the end of the day, you have the ability to mitigate risk in the event we do see the coronavirus accelerate and also provide a pullback in the actual NASDAQ 100.
Yeah, this is a really responsible way to look at the futures and options, mitigating risk, getting yourselves a little bit of protection to the downside, a little longer term in case you're looking at it. This is a 6-week-long trade.
Well, let's talk about the approach. Buying the 9,000, this is going out about 6 weeks. We're going to expire on March 31st. But buying the 9,000 put and selling the 8,700 put, you're buying that put, obviously spending that money on the premium, but you're selling the 87 to offset that expense. But this put spread is still going to cost about $510. I know it sounds like a lot, Bob, but that's 6 weeks of risk mitigation being spread out over the next couple sessions.
Right, again, when you look at it, June is the underlying futures contract here. It's trading about 96.21. That's a little bit off, but essentially what you're doing is you're paying for this futures and options protection for a little bit longer term, so it's not unreasonable of a price.
Yeah, it's about a 6.5% lower. That's the strike price of 9,000, but the at-the-money volatility was only about 16, so this makes a lot of sense in an approach like this, potentially mitigate risk to the downside in the NASDAQ or the tech sector by and large.
Yeah, typically that's a lower volatility for the tech sector with an event like this going on.
All right, Bob, well, thanks as always for coming on Striking Options, and please tune in every week as we will continue to strike options.